Wondering how ETFs can fit into your portfolio? Join us for our Fall into ETF Investing event, a 4-part YouTube series premiering on October 18th, 2024, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everybody, it's Larry Berman. Happy November. October broke the streak of strength in the U.S. equity market and globally, and a lot of things happening. But of course, earnings season, and the biggest thing overall, of course, is the uncertainty around the U.S. election. You know, a week ago, we told you that the market was betting heavily on Trump. And as we look at how things went out Friday, very different picture in mind. So let's take a dive into the chart room and see what we learned this week. The predicted betting pools a few days ago, as we roll the clock back a week here, to the beginning of the week, and you see that Trump was up at 62%. And so if you're paying 62 for a contract that settles at 1, you're almost giving 2-to-1 odds that Trump was going to win. And, you know, same on the other side, if you're looking at selling Harris. As we go out Friday, this is a little unusual. You've got a 52% chance that Harris is going to win and a 54% chance that Trump is going to win. So, again, I don't play these online markets at all, but unless there's a VIG here, it doesn't make any sense. You would sell both of them and make a profit. So there's obviously a VIG there, but really kind of unusual how things are going. You know, but what we've been watching with great interest is the volatility in this stock. You know, DJT, Donald Trump, Truth Social, media. And as I said, if Trump loses the election, I think this stock goes out of business. At the peak earlier this week, it was apparently valued at the same as what Elon Musk paid for X, which is mind-numbing. You know, when you think about what this is. So I think prediction, don't hold me to it, but you know, if Trump loses the election, I think you're going to see a degree of civil unrest across the U.S. that makes, sadly, and I can't believe I'm saying this, January 6th look like a nothing event. And, you know, he said something in a speech about holding a gun to some, I don't know. I'm just blown away at how people dismiss his rhetoric as though it's just Trump. And so I have a massive bias. I have such a dislike for the person that, you know, it's hard for me to be really clear here on my thinking. And while I'm not a Harris supporter by any stretch of the imagination, I still think she's probably the right call for America. Versus what Trump would do, and almost certainly what would likely happen under a red sweep. And so a couple weeks ago, it was looking like a red sweep was actually possible. And as we sit here, you know, just literally hours before the U.S. election, something different is going to happen. So I think Harris ends up being the president. And it's looking at this place like this at this point that Congress could actually be split. It's going to be that close, and almost certainly on election night we aren't going to know. So what does that mean for markets? This week reportedly was the biggest outflow week of the year from institutional managers, meaning they sold into it. And so, the idea that we were going to get a post-election pop and people would liquidate maybe was a narrative that people took advantage of this week. We saw that massive amount of selling and reversal in lots of things this week. So kind of interesting there. The one thing that continues to point to a Trump victory is what's happening to the long bond. Now, in any scenario, this week we got the quarterly refunding announcement, Yellen's funding with bills. There is a narrative that they were waiting on that till after the election, and almost certainly they're going to have to come back with a lot more coupon debt, and the pressure on long-term rates is going to be pretty significant no matter who wins. But under a red sweep would be the worst case scenario for bonds. So the bond market's a challenge. And so when does the stock market start to care again? And the answer will be post-election, I believe. So, those looking for a grind higher into year end, I think is misguided at this point. And if we do get a post-election pop, I think you got to raise some cash. And so, when we were talking a couple months back in around the Fed 50 basis point rate cut, where it looked like lawn bonds were going to break through here, I was extremely cautious, saying that there really is no term premium and there's no value here, and that the supply situation, which we're now talking about, is in front of us. And so where do yields go? If this trend line does break, clearly 480, and can we see longs above 5% again? And so the answer is yes, we can. But I think you back up the truck there from a trade perspective, because the higher yields stay, the less accommodative the Fed can be, because inflation is jobs and inflation are still, notwithstanding the employment report on Friday that had all kinds of weather and strike issues in it. And we won't know for another month or two how clean that is. Initial claims data is still very, very, very benign. And historically, I know that to me is the leading indicator when we start to see layoffs on a regular basis, on a broad basis in the economy, that's the turning point. And there's clearly no evidence of that yet, although we've had a couple week-to-week false starts this year. So that's kind of the big picture here. And so when you look at, September 50 basis point rate hike, or rate cuts, pardon me, and you look at where the curve was steep. So the curve was very steep, 2s to 30s, in line with that rate cut. There was a little more follow through, but it's painfully obvious there was no way they were going to be able to cut rates that much. And what you see now is this week in particular is what's called a bear steepener. And a bear steepener is bad for asset markets. A bull steepener is bullish for asset markets, and that where interest rates overall are falling, led by cutting on the front end, where now we've got the curve steepening, but it's led by selling on the back end. A bear steepener is not good for asset prices. So that's in front of us. When we look at what's priced in, in all likelihood, the Fed cuts this week. I don't think the election's going to matter. I think for the most part, they're convinced they need to cut, just given that inflation has come down so much, and just to take out some of that. But really, the market right now, the Fed balance sheet, everything, the financial conditions are still very, very easy. Credit, where it's trading, financial conditions are very, very easy. And I just don't think and expect them to be able to cut rates so much. Now, at some point, we're talking about a hard landing next year. And again, when that happens, I don't know. But it's clear to me that we're starting to see some value build out if you look out a year and a half on where short rates are. So that's a big point to think about and an opportunity at some point, but we're not there yet. In Canada, December 11th is the next Bank of Canada meeting. And again, 50-50 whether they cut 25 or 50. And I think it'll tilt one way or the other depending on what we see in the next couple employment situation reports out of Canada. And, based on that, the leading indicator being the Canadian dollar. So it looks like if we see weak Canadian employment numbers this week coming up on Friday, that we continue to drift higher, 141, 142 area, and somewhere in there for you out there, you want to lock in that, and you want to sell your US dollar exposure. So where you have ETFs that are not hedged and you've benefited from the stronger US dollar, I think you want to start rotating things into where you can hedge that currency risk. One of the best and worst trades that I ever made was calling the market bottom in 2002, 2003 timeframe after the dot-com bubble, and went out and bought the NASDAQ with the Qs back then. There were no hedged versions. And so made a massive amount of money in the coming years in the NASDAQ as it started to recover, and lost a bag of money on the currency because at the time the Canadian dollar was much weaker than it when it is today. And so ultimately, when I doubled my money or close to it in the NASDAQ after the foreign exchange, wiped out about 25% of my gain. So, that's very, very real, that currency impact on portfolios, and should never be ignored. Anyways, have a great week. There's going to be no shortage of crazy volatility, I think, in front of us here into the end of the year.